Amazon shares plummeted 13% in extended trading on Thursday after the company issued a disappointing fourth quarter forecast and missed on revenue estimates. Amazon said it expects to post fourth quarter revenue between $140 billion and $148 billion, representing essentially year-over-year growth of 2% to 8%. Revenue grew 15% in the third quarter, marking a return to double-digit sales expansion, but it still fell short of Wall Street's projections. Like the rest of big tech, Amazon has had a very rocky year so far as it confronts macroeconomic headwinds, soaring inflation, and rising interest rates. For more on this now, let's get to Susannah Streeter, who is an investment analyst at Hargreaves Lansdown. Susannah, many thanks for being with us today. So we know that all of these challenges we've spoken about actually coincide with a slowdown in Amazon's core retail business that's consumers return to shopping in stores this year. I mean, do you think the company should tweak the strategy moving forward? What is it doing at the moment?
Well, I think realizing has dawned on the financial markets that big tech is not immune to the slowdown, and this is clear in Amazon's results. Now, what it tried to do was really capitalize on that surge of pandemic business as people turned to e-commerce through lockdowns, and so expanded very rapidly. Now, what should it do? Well, it's already now trying to cut costs almost just as rapidly. It's just they're not coming through as soon as the market had been expecting. And actually, costs rose by 18% in the third quarter, but there is cost cutting going on. So really contracting from the huge hiring spree that Amazon took on. Because of course, as you say, shoppers' habits have changed. Not completely, we're still not back at pre-pandemic e-commerce levels, but certainly shoppers have been going back to physical stores once again, which is denting Amazon's revenues. And the other aspect to it is that people are shopping around for bargains. And while Amazon is extremely efficient, it's not always the cheapest. And so that is also probably hurting its e-commerce arm as well.
Right, and Susannah, we were just speaking a moment ago about the ECB having to control inflation at this point because purchasing power is going down. We've seen that soaring inflation, rising interest rates are really having an impact on the tech sector across the board. What do you expect on that front for the end of the year, the beginning of next year, in terms of interest rates hikes in Europe, mainly?
Certainly, as we've been hearing from the European Central Bank, and they made it clear yesterday as well that hikes would continue. However, they are sensitive to the economic environment, but simply inflation is considered to be the biggest threat, not a recession, because the problem is if you keep having a spiral upwards of prices, then that could become embedded within the economy because workers will be expecting higher prices, so they'll be clamoring for ever more higher wages. You'll continue to get this real industrial strife. And the worry is that actually, if higher wages are passed on, it will mean that actually everything has to keep getting more expensive to pay for those higher wages. And that is why the European Central Bank and other central banks want to stop this in its tracks and really focus on inflation first and then tackle the recession with potentially some policies to help, or certainly governments would be expected to then help on the fiscal side for growth further down the road, but only once inflation has become under control. But certainly economies will need another helping hand, that's for sure, once those inflationary pressures have eased.
Interesting, Susannah, then inflation being the real threat at the moment, not recession. Susannah Streeter, thanks for being with us today.